Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Hope you guys are doing fantastic. Well, happy Friday. Well, interest rates are finishing the week once again worse than where they ended last week, and this is about a 4-week actually worsening of interest rates. We've lost about 0.3% from the very end of January, where interest rates were in the high 3% level, and now we're in the low 4% level. Still fantastic, but we're seeing a bit of a pullback in interest rates, mainly happening due to just the stock market continuing to get better. The big mover this week here was the jobs number. The employment report came out, and it showed some big surprises. Expectations were for about 240,000 jobs added to the economy. The actual number was 295,000, so a real big jump on what has already been, pretty good increases to the jobs numbers over the last few months. We also saw the unemployment rate go from 5.7 down to 5.5%, so a pretty big movement in the unemployment rate. Expectations were for the unemployment rate only to go to 5.6%, but it actually went to 5.5. Now, on the other side of the coin here, so those headline numbers, look real good, but there's some things down below the surface that maybe aren't so good. We saw the labor force participation rate, which actually measures how many people are actually in the workforce. Remember, if someone's not looking for a job, then they're not considered part of the numbers, so that's why that unemployment rate can actually go down. And the labor force participation rate actually went down to 62.8, which again is one of the worst levels ever. We also did see hourly earnings come in lower than expected, so even though that there's more jobs, they may not be the high-paying ones, and even though that unemployment rate went down, a lot of it is just because people have just stopped looking for work. So the jobs figures maybe aren't quite as strong as what the headline numbers might suggest. Now, also throughout the week, we did see some economic data that really didn't show that the economy is doing fantastic. Again, let me just remind you, these jobs numbers, anything that's good for the economy typically is bad for interest rates. So the headline numbers on the jobs looks like that's great for the economy, and that's one of the reasons why interest rates are getting a little bit worse. Anything bad for the economy is typically good for interest rates, and when the inflation level is low, that's also good for interest rates. And we did see the personal consumptions indicator, or expenditures, which is the Fed's favorite measure of inflation, and that showed that inflation is under control, only increased about 0.1%, and the year-over-year number is only at 1.3%. So still the inflation target is lower than what the Federal Reserve wants. Bottom line is here, though, what's going on is that as long as the stock market is doing well, which it is, now today, even though the jobs numbers were stronger than expected, at least right now, stock market is not liking that. So both interest rates, both the bond market and stocks are really not liking this overall job number. But as long as the stock market is doing well, interest rates are going to be where they're at or suffer a little bit, because money is flowing in to the United States from Europe. What's really driving this whole sucker is what's going on in Europe. Right now, Europe is not having a very good economic time, and so the money is flowing into the United States looking for higher yields. Right now it's going into the stock market. If the stock market stumbles, that's what would cause interest rates to get better, because then money would flow from stocks into mortgage-backed securities. It's not happening right now. Who knows if it will ever happen, but most of the experts that I follow believe that there is going to be a bit of a correction here in the stock market. Who knows if that's going to happen? But it might, and if that happens, then interest rates will get better. But as always, we're going to keep you informed and let you know what's going on with interest rates. If you're working this weekend, so are we. So if you have any clients that need any help, please give us a call. But right now, again, just tell your clients, when interest rates are so great, take these opportunities. If it's good, if you're liking it, lock it. Don't try to get greedy and try to time the market, because that's just difficult to do, especially when interest rates are so darn low. So thanks for joining me with Java with Jared. We'll keep you informed. Have a happy weekend, and we'll talk to you soon. Bye-bye.